Okay, welcome to the deep dive. We're diving into some source material you shared with us, a flyer specifically that explores a topic many people are curious about: how to potentially seek both current income and long-term growth in the market.
That's right. And this particular flyer, it really hones in on two specific ETFs, exchange-traded funds, mentioned as options for this, JEPI and JEPQ.
And our mission for this deep dive is really to unpack what this source material says about these funds. We're going to look at their key features, what the flyer presents as, well, potential benefits, and critically, the risks highlighted. All strictly based on the information in this document.
Yeah, the flyer basically sets the stage. It presents these two ETFs as tools aiming to deliver monthly distributable income alongside potentially capturing some market upside with the goal of, well, maybe less volatility than the broader market indexes.
Okay, so let's get right into it then. The flyer seems to focus on achieving this goal using these two different approaches, right? Represented by JPI and JEPQ.
Exactly. So JEPI, according to the source, gives you exposure primarily to stocks within the well-known S&P 500 index.
And it aims to do that while generating income. The flyer gives specific figures here, listing a 30-day SEC yield at 8.20%. It notes this is both subsidized and unsubsidized. What does that actually mean?
Right. So subsidized and unsubsidized basically tells you if the fund manager might be temporarily boosting the yield, maybe by waiving fees. Showing both gives you a clearer picture of the underlying yield versus any temporary support.
Gotcha. Okay. And the source also shows the 12-month rolling dividend yield looking back over the past year at 7.51%. These figures are as of late March, April 2025, depending on the metric.
And the expense ratio, that's the annual fee the flyer mentions, it's 0.35% for JPI, both net and gross listed as the same figure as of March 31st, 2025.
Okay. What about performance? The flyer has historical figures for JPI.
It does. For the one-year period ending March 31st, 2025, it shows 6.27% based on net asset value, NAV, and 6.30% based on its market price.
Right, NAV being the underlying value. Market price, what it actually trades at. Sometimes a small difference there.
Exactly. And since JPI launched, back in May 2020, the flyer shows a return of 11.84% at NAV and 11.85% at market price.
And it puts that in context against the S&P 500 index returns for those same periods.
Yeah.
8.25% for the 1 year and 15.72% since JPI's launch. So lower return than the index in this period.
Correct, based on this data. Now, the second ETF discussed is JEPQ. It takes a slightly different angle, focusing on exposure to the Nasdaq 100 index.
Which, as the flyer points out, usually means a heavier concentration in growth sectors, like tech.
Yes, and maybe reflecting that, the income characteristics listed in the source for JEPQ are actually higher than JPI's figures shown there. The 30-day SEC yield is 12.42%, again, both subsidized and unsubsidized.
Wow, quite a bit higher. And the 12-month rolling dividend yield?
Listed as 10.68%. Also, as of late, April 2025.
And the expense ratio for JPQ?
Same as JPI in the flyer, 0.35% net and gross as of March 31st, 2025.
Okay, and JEPQ's performance, according to the source, 1 year ending March 31st, 2025.
It shows 5.88% at NAV and 5.90% at market price.
And since its launch, which was May 3rd, 2022.
The figures are 12.64% at NAV and 12.65% at market price. And again, compared to its benchmark, the Nasdaq 100 index, which returned 6.44% for the 1 year and 15.22% since JEPQ's launch, according to the flyer.
So again, lagging the index over these specific periods shown, but the flyer adds a note about JEPQ's peer performance.
It does. It mentions JEPQ outperformed 69% of peers over latest 1 year period based on return within its specific Morningstar category derivative income as of March 31st, 2025. So relative to similar strategies, it did well in that time frame.
Okay, so we have JPI on the S&P 500, JPQ on the Nasdaq 100, both aiming for income. How do they actually get that income?
Well, the flyer says they aim for consistent monthly income through a combination of stock dividends and the strategic use of options.
Ah, okay, so this is the strategy part. The flyer connects this income goal to how they operate, mentioning investments in equity-linked notes, ELNs, also derivatives, and something called a put spread collar options overlay strategy. That sounds pretty involved.
It is, yeah. Let's try to break that down a bit based on the flyer's description. The core idea, or part of it, is generating income by selling options. When you sell an option, you get cash up front, right? That's the premium.
Okay, you get paid that premium?
And that premium forms part of the income that gets distributed monthly.
But what's the catch? What are you giving up when you sell that option?
Well, typically, by selling certain options, like call options on stocks you hold, you're essentially agreeing you might have to sell those stocks at a set price if the stock price goes way up. So you pocket the premium income.
But you cap your potential gains if the stock skyrockets.
Exactly. That's a key part of the trade-off described in the source. Generating income, but potentially limiting how much you participate in big upward moves.
Got it. And the flyer also mentions ELNs and derivatives generally.
Yes, it indicates they invest in these. Equity-linked notes, ELNs, are basically debt instruments, but their return is tied to how an underlying stock or index performs. They can be used for exposure or income.
But they sound complex. We'll get at the risks, I assume.
Oh, yes. They have their own complexities. And derivatives, well, that's a broad term for contracts whose value comes from something else, an asset, index, rate. Options are one type. The flyer positions these as tools used alongside the stocks to execute the income strategy.
Okay, so the strategy is stock dividends plus income from these complex instruments like options and ELNs, potentially limiting some upside. Now, the flyer also talks about combining JPI and JEPQ. Why suggest that?
The source suggests combining them could broaden your exposure, especially to those growth stocks more common in the Nasdaq 100, and sort of participate more fully in the overall U.S. equity market picture.
And there's a specific reason given in the flyer for this blend idea.
Yeah, it points out that JB on its own caps how much it holds in any single sector at 17.5%. The source states this actually creates a structural underweight to the S&P 500's tech sectors compared to the index itself.
So because JPI limits sector weights, it ends up holding less tech than the S&P 500 overall.
Right. So the idea presented is if you blend JBI with JPQ, which has that heavy Nasdaq 100 tech exposure, you can address that underweight. The flyer uses a hypothetical example like 60% of JPI, 40% JEPQ.
Just an illustration, they stress.
Purely illustration, yes. But it suggests this kind of mix could give investors S&P-like sector exposure, meaning their combined tech holdings might look more like the S&P 500 index itself. They mentioned visualizing this with the sector allocation chart concept.
That makes sense, using JEPQ to sort of dial back up the tech exposure that JPI might be limiting. So the flyer then shows some numbers for this hypothetical blend.
It does. And again, super important, the flyer emphasizes the 60-40 mix is just hypothetical, not a real fund. The data shown is as of March 31st, 2025, but uses a common start date of May 4th, 2022, just so they can compare performance over a period.
Okay, so the blended yields shown in the source are higher, combining the two. It lists a 9.89% 30-day SEC yield and an 8.78% 12-month rolling dividend yield for this theoretical blend.
And then it shows performance characteristics for this blend from that May 4th, 2022 start date through March 31st, 2025, comparing it directly to the S&P 500 index over that exact same period.
Okay, let's see those numbers. The blend's cumulative return is shown as 10.15%, the S&P 500 over that same time, 12.43%.
Right. And volatility, measured by standard deviation. For the blend, it's 14.69. For the S&P 500, it was 20.21.
So noticeably lower volatility for the blend in this period. And the Sharpe ratio, risk-adjusted return.
For the blend, it's 0.57. For the S&P 500, 0.61.
Okay, so what does that pattern tell us? Lower return, lower volatility, slightly lower Sharpe ratio for the blend versus the S&P 500 over this specific historical window.
It really illustrates the potential trade-off, doesn't it? For this period shown in the hypothetical, the strategy achieved lower volatility, which was a goal, but it came at the cost of lower total return compared to just holding the S&P 500 index. The slightly lower Sharpe ratio suggests the return wasn't quite as high per unit of risk taken compared to the index during this time frame, based on this data.
Yeah, that lines up with the strategy description, aiming for income, aiming to smooth the ride, but maybe giving up some upside, especially if the market itself is doing well.
Precisely. And this naturally leads us into the risks. The source material highlights these, and they're really important, especially with those complex instruments involved.
Right. First up, the flyer lists general equity risk. Just the basic fact that stock prices go up and down, sometimes quickly, and you could lose money.
Standard stuff. But then it gets specific to the strategy. Remember those ELNs? Equity-linked notes. The flyer details risks there, including liquidity risk.
Meaning they might be hard to sell or value properly.
Exactly, because they don't typically trade on major exchanges like stocks. And since they're debt-like, they have debt security risks, mentioned credit risk, counterparty risk. Basically, the risk the issuer can't pay up.
And the source warns, that if the underlying thing the ELN is linked to doesn't perform well, you might not get the expected benefit and could even face significant losses, possibly the whole principal.
That's what the source indicates as a possibility for the ELN portion. Then it talks about derivative risks more broadly, stating they're generally riskier, more sensitive to market moves, and can create leverage.
Leverage meaning small price changes can lead to much bigger gains or losses, potentially more than you initially invested.
Correct. And specifically for the equity option risks, part of that put spread collar thing, the source notes that while options can be used to reduce risk, selling them, like they do for income,
Limits your chance to profit from big upside moves. We covered that trade-off.
right. And the flyer adds that options might not work as expected in unusual market conditions, or if there isn't a good market to trade them in, which could lead to losses.
Okay, and then there's an overall strategy risk mentioned.
Yes, the source basically says that using this combination, the stock portfolio plus derivatives plus the options overlay might not actually provide the level of market protection or volatility reduction you hope for.
Especially in weird market conditions or if the options market isn't working well.
Exactly. The flyer also mentions risks like mispricing or improper valuation of these complex instruments. And if derivatives are used for hedging, trying to offset losses, there's a risk the hedge doesn't work as expected, the values don't correlate properly.
Wow, okay. Those are really significant points. It shows that while the aim is income and lower volatility, the strategy itself introduces a whole different layer of complexity and specific risks compared to, say, just buying an index fund.
Absolutely. And the source material wraps up with several really crucial disclaimers. These frame all the information and are vital for you, the listener, to keep in mind.
Number one, past performance, like any figures shown, is absolutely no guarantee of future results. Emphatically stated.
And it reminds you, investing always involves risk. You could lose money, including your entire principal.
Your investment returns and the value of your shares will fluctuate. So if you sell, you might get back more or you might get back less than you put in.
The source also clarifies that these ETFs have fees, expenses that reduce their performance, unlike the indexes they compare against, which don't have fees and you can't invest in directly anyway.
And it's very clear. This flyer is just for informational purposes. It is not a recommendation for you to buy or sell anything. Any hypothetical examples like that 60-40 blend are purely for illustration.
And finally, the source strongly advises that before you make any investment decisions, you should seek personalized advice. Talk to qualified financial, legal, tax advisors about your own situation. And it stresses reading the fund's prospectus carefully. That document has even more detail on risks, fees, objectives.
So let's recap for you. We've taken this deep dive into the source material you shared, looking at how JPI and JEPQ are presented as potential tools for current income and growth.
We covered their different focuses, right? JPI on the S&P 500, JEPQ leaning more towards Nasdaq 100 growth. We looked at the specific yield figures provided for each, showing those targets for potentially high monthly payouts.
We also explored the strategy the flyer mentions, how they aim for this income, using dividends plus those complex instruments, options, ELNs, derivatives, and the idea presented of maybe combining the two ETFs for broader exposure.
Yeah, and we reviewed the performance shown for that hypothetical blend over that specific past period compared to the S&P 500, highlighting that potential trade-off, lower volatility shown, but also potentially a lower total return during that time.
And critically, we've summarized the various risks that the document itself highlights, from general market risk to the very specific ones tied to the derivatives and option strategies being used.
And, of course, included those essential disclaimers that really put everything in context. Hopefully, understanding these details from the source material helps you as you evaluate different approaches, perhaps if you're exploring income-generating strategies for your own potential investments.
Which brings us to a final thought, something for you to consider as you process all this. Given that these ETFs, according to the source, use complex instruments like ELNs and derivatives with their own specific risks, how might that potential for enhanced income and maybe reduced volatility shown over a specific past period be fundamentally intertwined with different, maybe less obvious types of risks compared to just straightforward stock investing? And what questions does that raise for you about evaluating strategies like these for the future?